back to our Wealth Builder series. Hi, I'm Lisa Ward, your founder and CEO of Plum Financial. So, we are going to focus on the basic terms for your employer sponsored retirement plans. And the first thing you need to understand is the employer match. This is free money. Because you work for an employer that has an employer sponsored retirement plan, you get additional money without being taxed on it today, which is great. So, how does that work? Well, if you work for a small business, you might have a simple IRA, and that is a straight 3% for 3%, meaning you contribute 3% of every paycheck. Your employer will also put in 3% of that paycheck. Not from that paycheck, but from their, money from the business. So it's not additional money out of your pocket, but free money, which is fantastic. Now, employer matches might not be that straightforward. It might be 50% up to 4%. You're like, oh gosh, Lisa, that's like algebra. Yes, it is. The reason why a structure like that is to entice the employees to save more for retirement. So if that's what your employer match language sounds like, that means you have to put in 8%, and then they will match half of that, which is 4, and the max they will go up to is 4%. So to get the full match, you have to put in 8 for them to put in 4. So understanding how your employer match works is step 1, and take advantage of the free money. Then the next step is understanding your vesting schedule. So there might be a vesting schedule within your 401k if you work for a for-profit company, meaning you have to work there for 3 years, 5 years to keep the employer match. Obviously, the money you put in is yours from day one. So if you leave the company, all of that money is yours, and you can roll that into your future employer's retirement plan. But to entice employees to stay at the employer, they can put a vesting schedule, meaning say 25% of the employer match is yours for the year 1 that you're eligible for your retirement plan. Year 2, it's 50%. Year 3, 75%. And year 4, you're fully vested. So, in year 10, say you get another opportunity and you want to go somewhere else, then all of the employer match is yours for the taking, and all of your contributions are yours for the taking to roll it into a new 401k. If you have a vesting schedule, but you left in year 2, well then 25, 50%, only half of the employer match will come with you when you leave your employer. So the other half basically goes back into the pool for the future employees. So it's a sticky way of keeping you so that you get to keep your retirement benefits for long term. And I mentioned rollover a few times. So what does that mean? So you work for your employer and new opportunity comes about, recruiter gives you a call and they're going to give you a promotion and they're going to give you more money. Like, well, of course, Lisa, I'm going to sign up for that. But what about my money in my 401k? Great question. Well, that can roll over into a qualified plan, so 401k to 401k, or could do a 401k if it's pre-tax to a traditional IRA, or a 401k if it's post-tax into a Roth IRA. And doing this in a timely manner is not a taxable event to you because it stays in the retirement account. It's not actually distributed to you. So the check isn't written to you as the individual. It's written out to your other investment retirement account. So it's a tax-free transition, and then you keep your money with you. Never leave money at a previous employer. Just don't do it. We end up forgetting about it. It gets lost. Make sure that you move, if and when you move jobs, we either roll it into IRAs or we roll it into our new employer's retirement plan. And then the last thing I wanted to go over was your contribution. So you might have heard the term dollar cost averaging. So because you're putting money into your retirement account, every time you get paid, you get to buy at that current price in the market. So the market goes up, the market goes down. So overall, if you average out those costs throughout the year, it has shown that your cost is lower than trying to time the market correctly and putting all of your money in at that time. So it is a fantastic thing to benefit from. So over a longer period of time while you are working, your cost is lower. So buy low, sell high. So dollar cost averaging helps with that. So if you're investing in a traditional IRA or Roth IRA, it might be prudent to do a monthly contribution versus an annual contribution and trying to time the market correctly. So if you guys have questions about that and want to review your 401k, 403b, or simple IRA through work, your retirement plans, please let me know and schedule your blueprint call today.